Just a few days ago, the market looked like it was entering a new wave of pressure. AI was perceived as a threat to business models. Tech stocks were being sold off, the Nasdaq was declining, and Bitcoin was losing momentum. Then Nvidia released its report, roughly $68 billion in quarterly revenue, above expectations. The stock surged, the Nasdaq closed in the green, and the crypto market added around $170 billion in capitalization in a single day. The question is whether this is just a technical bounce or the beginning of a new growth phase. Today, we'll break down what changed and which catalysts could push the market further. From fear to impulse. Before we begin, this is not financial advice. Everything I say reflects my personal view and judgment. Use it as an additional perspective, not as a call to action. A few days ago, AI was the reason for the sell-off. After statements about the capabilities of new models, the market began reassessing the durability of entire segments. IBM dropped more than 10%. The SaaS sector was trading 30 to 35% below local highs, and investors were pricing in substitution risk and margin pressure. The Nasdaq declined and tech beta compressed. On February 23rd, Bitcoin fell around 4.4% in a single day. Volumes spiked and liquidations accelerated. That was fear being processed through leverage. Then, the sharp reversal. Nvidia reported about $68 billion in quarterly revenue, exceeding expectations. This was not just a strong result. It signaled that hyperscalers are still spending and that AI infrastructure is scaling rather than contracting. The stock rallied, semiconductors gained momentum, and the Nasdaq closed higher. The market shifted its lens. AI stopped being a story about disruption and became once again a story about capital expenditure and investment cycles. On the same day, the crypto market added around $170 billion in capitalization. Bitcoin rose roughly 3.5%, Ethereum over 7.5%, and Solana nearly 8%. It is still unclear whether this is a structural break higher or simply a news-driven impulse. What matters is sequencing. The impulse came after a liquidation phase. First, the market flushed weak positions. Then it received a strong fundamental trigger. The combination of cleansing and positive earnings created acceleration. Artificial intelligence first amplified the sell-off through fear of disruption and replacement risk. Now it has become the growth catalyst through confirmed infrastructure demand. That shift in regime triggered the current positive move. The core question now is whether this is just a reaction to Nvidia's report or whether the regime is actually shifting. Without liquidity support, any impulse fades quickly. Start with growth. The latest estimate for US Q4 GDP showed annualized growth of about 1.4%, down from 4.4% in the prior quarter. That is a sharp slowdown. For the real economy, it signals cooling. For markets, it reduces tightening pressure. Markets trade trajectory, not static data. If growth slows without re-accelerating inflation, the cost of capital stops rising. That changes the backdrop for risk assets. Next are yields. When 10-year Treasury yields rise aggressively, crypto almost always feels pressure because real rates become a competitive alternative to risk. If yields stabilize or move sideways, risk becomes more defensible again. Markets react to the change in acceleration, not the absolute level. Then the dollar. A strengthening dollar historically coincides with global liquidity compression. If DXY stops rising, it suggests international dollar liquidity is not tightening further. For Bitcoin, which is highly sensitive to global capital flows, that is critical. Flows also matter. After liquidation phases, the market becomes structurally lighter. February 23rd marked a processing of panic. Volumes spiked and weak hands were forced out. Once leverage resets, less fuel is required to push prices higher. If ETF outflows stabilize and flows turn neutral, systemic pressure declines. Massive inflows are not required. What matters is that the institutional channel stops being a persistent seller. Positioning is another factor. After heavy pressure, markets are often positioned defensively. In that structure, a single strong catalyst can trigger short covering and rapid capital reallocation. That is why post-capitulation moves often look aggressive. Most importantly, the environment has become receptive to positive news. A few weeks ago, any negative headline amplified selling. Now, a strong Nvidia report sparks a chain reaction. Tech rallies, crypto follows, and macro does not resist the move. GDP slowdown strengthens expectations of policy moderation. Yields are not accelerating higher, and the dollar is not breaking to new highs. This is not a full bull regime, but it is a transitional phase where pressure is easing. If upcoming data confirm cooling without renewed tightening, the current impulse can gain structural footing. That is when the narrative shifts from relief rally to the early stage of renewed risk appetite. Now the key question is what can sustain the move further? We've already seen the first impulse. The issue now is continuation. The key dates ahead are March 6th, U.S. non-farm payrolls, and March 11th, CPI. Payrolls will show whether the labor market is overheating or cooling. Strong data reinforce rate pressure, moderate cooling supports softer policy expectations. CPI is even more important. If inflation continues to slow, yields could decline, the dollar weaken, and risk assets receive additional support. For crypto, which is highly sensitive to the cost of capital, any signal of rate stabilization acts as a green light for risk. The second factor is tech behavior. If the Nasdaq holds gains and semiconductors avoid renewed selling, AI will be viewed as an investment cycle rather than a threat. In that case, crypto receives a secondary beta impulse. The third is flows. Even moderate ETF stabilization after outflows would confirm that institutional selling pressure has subsided. No explosive inflows are required, just the absence of systemic selling. The bullish scenario is straightforward. Bitcoin holds above key levels and the impulse expands into altcoins as risk appetite returns. If incoming macro data align with market expectations and momentum remains positive, a breakout above the $70,000 resistance level would be the ideal setup. That would shift the structure from a short-term bounce to a more sustainable trend. The neutral scenario is consolidation while the market waits for macro confirmation. The bearish scenario involves accelerating yields and renewed pressure on the tech sector. In that case, the current impulse may turn out to be temporary rather than the beginning of a broader expansion. Thank you for watching. Like and subscribe, leave your comments, and remember, this is not financial advice, just my perspective on the market.